Hi, a very good evening to all of you. My name is Jake Damien Chow. I'm your host tonight, and on behalf of CGS-CIMB Securities Singapore, thank you for joining us tonight as we bring you part 2 of our webinar series, Dominance of the Virtual World, a New Normal, New Economy. Before we start, let's state our disclaimer. Tonight's webinar is purely for educational purpose and shall not be relied as investment advice and acted upon. We will try our best to present information as accurate as possible, and we shall not be liable for any investment losses due to any inaccuracies in the information. As a reminder, the audience is on listen-only mode, with all lines being muted. This webinar will be in an interview format, so over the next 40 to 45 minutes, I'll be fielding questions at our guest, and he will reserve the last 10 to 15 minutes for open Q&A. During the session, if you have any questions, do not hesitate to raise them in the Q&A function that you see on your Zoom platform. We will do our best to answer most, if not all, the questions after the interview segment during the open Q&A. Before diving into the new norm, let us revisit our history. As many are aware, technological advancements has always been the driving force behind social economic progression, shaping and transforming financial markets over the centuries. In the age of exploration, advancement in navigation and sailing technology enabled the Europeans to sail long voyages in search of trade routes that indirectly led to the birth of the first stock exchange in the Netherlands. The first industrial revolution was driven by cheap energy in the form of coal, alongside with the invention of steam engine made mass production of goods possible, and this accelerated economic growth. A century later, the second industrial revolution was sparked by the discovery of electricity and light bulbs, allowing factories to operate second and third shifts. Emergence of new energy sources such as gas and oil also helped to power the newly invented internal combustion engine to reach the full potential of mechanized production. These developments led to the improved efficiency in mass production of consumer goods, such as automobiles, planes, and telephones. The third industrial revolution, also known as the digital revolution, is the shift from mechanical to analog to digital technology. It brought forth the rise of electronics, telecommunications, computers, and nuclear power. And through these new technologies, we open the doors to space exploration, biotechnology, and robotics. The speed of the current breakthrough has no historical precedent. When compared with previous industrial revolutions, the fourth is evolving at an exponential rather than a linear pace. Moreover, it is disrupting almost every industry in every country. And the breadth and depth of these changes herald the transformation of entire systems of production, management, and governance. The possibilities of billions of people connected by mobile devices with unprecedented processing power, storage capacity, and access to knowledge are unlimited. And these possibilities will be multiplied by emerging technology breakthroughs in fields such as artificial intelligence, robotics, the Internet of Things, self-driving cars, drones, 3D printing, nanotechnology, biotech, material science, energy storage, and even quantum computing. AI has made impressive progress in recent years, driven by exponential increases in computing power and the availability of vast amounts of data. We now have software that can speed up the discovery of new drugs, to algorithms that can accurately predict our interests and our spending patterns. Now, bear witness with us on how the fourth movement, The information revolution is reshaping our lives and investment possibilities. Joining us tonight is Adrian Chu, VP of Sales and Product Strategy with CSOP Asset Management. Adrian, please say hi to our audience tonight.
Hello. Hi, good evening, everyone. Happy to be here. Thank you for your attendance for tonight. And I would like to thank CGS-CIMB for organizing such a webinar for us. A very interesting topic tonight. Jake?
Thank you, Adrian. Just in case you're wondering, Adrian oversees ETF investment solutions for brokers, wealth managers, and family offices in Singapore. He's also responsible for developing sales strategy and strategic partnerships with institutions in Southeast Asia. So, Adrian, would you like to introduce CSOP to our audience?
Sure, most gladly. So CSOB was established in 2008. We are the first offshore Chinese company that is being regulated by the Hong Kong SFC. We do have over 7 professions, managing more than $8 US billion in asset. Our flagship ETF is actually the FTSE China A50 ETF. The asset under management, it's about for Hong Kong $14 billion. And just this Monday, we launched a flagship Chinese government bond ETF on SGA with the initial AUM of more than about 700 million USD of AUM. So we do have a strong shareholder background. One of the major shareholders is China Southern Asset Management, established in March 1998. We have a registered capital of RMB 300 million. Can you mute yourself? Sorry about it. Yeah. So we have a total of RMB 1.8 billion. We are ranked 5th among the mutual funds in China. And also one of the group shareholders is Huatai Securities, established in May 1991 with a huge market share of 7.9 in China. Besides doing what we do, besides managing a huge AUM, we have won many awards. And in year 2019, last year, in Asia Asset Management has awarded us CSOP as the ETF manager in Hong Kong and in Asia. So we in Singapore, we did set up a physical office. We are the first Chinese asset manager to establish an office in Singapore that develop wealth management business, a wide spectrum of business. We are also the first asset manager to be in the pilot test to launch a VCC framework in Singapore. And with this listing on Monday, we are the first. We is the first manager to launch a VCC ETF, which is called the ICBC CSOP FTSE Chinese Government Bond ETF, just on Monday.
Thank you for the introduction, Adrian. The most recent ETF that you launched has got a very long name. Yeah. And I've been working from home for the last 6 months, and I have no idea when I'll be going back to office. So how has COVID affected you?
Well, with this webinar, it's it's actually an indication of change of habit and how we communicate. We used to run, huge seminar, physical seminar, to meet up with our clients face to face. Having such meetings. But right now we're using technology ever more. With the current pandemic, I believe humans are adopting technology at a faster pace. To continue to establish communications among human beings right now. So true enough, we've been doing a lot of education seminars via webinars, and I believe that the pandemic has actually changed our habits as humans. Yeah.
Yeah, I guess we have to embrace and adapt to a new normal. As the COVID-19 pandemic has really changed the world, we see a lot of businesses losing their market share and end up having to fall up. So since the lows in March, the big recovery has mainly occurred in the new economy, especially in technology and biotech. So back to the stock market. In 2009, Shenzhen Stock Exchange launched the ChiNext board, which has been referred to as China's Nasdaq, attracting innovative growth-oriented Chinese firms, including many high-tech companies. And since then, the ChiNext board has grown significantly over the last 10 years. And today, it comprises of more than 851 listings with a total market cap of more than 9 trillion renminbi, representing nearly a quarter of the Shenzhen Stock Exchange. So, Adrian, I would like to hear your outlook on the Chinese markets.
Well, most certainly to share a house view, what CSOP views about the China market. We pride ourselves as the, we're pretty humble and pride ourselves as the Chinese market expert. So here's our two cents worth. Now, before we jump into the details, let us look at how China get from where they are today. So back in 1952, China was actually only generating a GDP of about $68 billion yuan. However, within 50 years, in 2010, China has actually overtaken Japan as the second largest economy in the world. And having said that, in another 10 years, from a $68 billion GDP, they moved to 99 trillion. They have grown to 99 trillion yuan in 2019. So within a span of just 20 years, right, China has actually grown to be one of the major player globally. Just within the 20 years, they have managed to garner such fast improvement in terms of GDP. And in 2019, the real GDP growth rate for China is over 6%. So, in summary, right, China right now is actually a major power player. It's no longer an emerging market. It's actually a strong country, a force to reckon with globally. And having said that, China has been the first, she is the first country to suffer from the COVID-19 pandemic, right? And she has actually done well. She is actually the first country to emerge from this health crisis. And having said that, China is actually in a much better position than the rest of the world to recover from this calamity. And so, there are many, but just saying this, we do have figures to indicate the recovery. Recovery has continued into August. Looking at the PMI, the manufacturing PMI, it has actually hover above 50%, hover above 50. So anything that any index that come in, any readings that come in above 50 show expansion. Anything below 50 show contraction. So from June, July, and August, the Chinese PMI has actually been at 50.9, 51. So they have been consecutively showing expansion. And two reasons for such expansion is one, increase in production is because one, during the lockdown, when the world is actually going through a lockdown, going through a circuit breaker mode, when the economy starts, when the economy starts, the factory restarts in China, they are faced with a backlog of orders, and they are actually ramping up production to satisfy such backlog orders. Second is actually also some of these countries wish, or maybe some of the companies wish to increase the inventory as a backup in case should there be another second round or third round of the COVID-19 waves. And having said that, the recovery is not actually balanced. It's actually looking at the manufacturing is okay, but the faster recovery is actually more weakness in the service sector. So you could see that in August, the non-manufacturing PMI is at 55. So it's actually growing at a much faster recovery pace. So having said that, some of the bright spots that we discussed here, we need to understand that there's an internal domestic issue, unemployment. So the Chinese government needs to keep a close eye on the unemployment rate within China. And I mean, there's a forecast of just by the end of this year, there'll be 9 million fresh graduates entering the workforce. And if the economy stays slow or in the comatose stage, the unemployment rate will be high, and with unemployment rate being high, domestic consumption also will be reduced. So the Chinese government probably have to think of stimulus package, supportive measures to keep unemployment down, to keep employment at full. So just to sum it up, is actually we need to Chinese government right now, China is actually in a very good position in terms of spearheading the recovery, but on the back there's a nagging issue of looking at the unemployment numbers. Next, China has a very positive outlook. If you look at the chart on the right, the World Bank Global Economic Board believe that China is the only country with a positive growth outlook. They were thinking, they forecast that world will actually have a -5 contraction for the year, but only China is the only one that is actually forecast to end positive of a growth of 1% for China, right? This optimistic growth expectation is actually based on two assumptions. One is actually the U.S.-China trade tension. The U.S. will simmer down after the November election, and also that the COVID-19 situation within China and also globally is well controlled. So this is based on the two assumptions. Should China and the U.S. trade tension would go away after the election, we forecast in 2021 the GDP growth for China a year on year will be about 8%. So it's actually much higher looking at the past history. And also we believe that what we're driving this growth is actually the retail sales. We're looking at about 16% year-on-year growth for retail sales. This also we believe that being cooped up for so long with circuit breaker and can't go out to do shopping, we'll see a spike up in revenge buying. So that will actually drive up the retail sales. Likewise, import export will also recover from a contraction in 2020 into we forecast into a positive 7 to 14% respectively. Now, so again, tricky thing is actually to watch out is actually the consumption, right? Internal domestic consumption has been the major driver for GDP growth in the past. If you look at the chart on the left, the red bar, this is what consumption has been contributing to the total GDP growth for China. So the key thing is actually China again needs to couldn't stress it more is to look at the unemployment rate. China needs to look at that, and also if possible reoccurrence of the pandemic, right? That would also restrict the consumption recovery. Now we also did a test, in terms of consumer, what kind of, when we're talking about consumption, what are consumer goods, what are the major categories of consumption goods the Chinese are actually buying. And to no surprise and relevant to the theme of the webinar today, most of the people are actually going to, adopting technology and doing a lot of online retail buying. So again, Jake, I couldn't say much about, the change in terms of the behavior of consumers or consumers. Yes. So where do you think, China has been on a path of recovery and all. So where is the growth potential? So CSOP felt that, A shares or the onshore Chinese market is actually better positioned versus the emerging market. Because, as we couldn't stress earlier in the PowerPoint is that China returns to potential growth in the fourth quarter due to the first in, first out. Versus the global macro recovery is not so clear, it's uncertain. Some of countries like Brazil, India, US are still facing persistent high numbers of the COVID-19. So we believe that China stock market is actually in a better position to lead the recovery. And with the strong external balance sheet and strong solvency, we could see that most of the policies are skewed to generate the new economy. And what is the definition of new economy in this sense? Is that it's actually more of like high growth in industry, in looking at technology. So Jake, probably I have to go back to the previous slide. Thank you so much.
Sorry.
Yep. So I mean, look at the comparison of major indices around the world globally, right? ChiNext, the CSI 500, MSCI China. So you could see out of 5 indices that's in positive, 4 is already belongs to the Chinese market. Thank you. So now we see is that these are some of the areas, some of the growth potential. But what is actually driving this where are all this recovery coming from? So we witnessed a large overseas capital inflow into the China market. If you look at the chart on the bottom right, in March there was outflow of capital from China. And that's actually because that was actually the height of the COVID-19 situation. But ever since then, in April, May, June, July, August, overseas capital flows are actually coming back. And where are they going to? They're actually going to information technology. They're actually going back into healthcare, industrials, and material as well. So what I'm trying to say is that China is actually on the path of better recovery. Growth is actually skewed to the new economy, and ChiNext is actually the major beneficial from the recovery and large overseas capital inflow. Yeah. And not only that, if we discuss a bit of the currency exposure that ChiNext is actually exposed to, renminbi has actually strengthened against the US dollars in the recent month. So if point number 1 is actually China is in a favorable growth cycle. China is actually in the rebound stage of the growth cycle versus to US, where they are still finding a solid ground for and trying to flatten the curve for the COVID-19. They are they're actually probably one stage behind behind China right now. 2, China is actually experiencing a huge external trade surplus in July. That's actually supporting the renminbi as well. 3, on the top right-hand corner, the yield spread for 10-year Treasury is actually a historical high. China Treasuries or China fixed income, government fixed income are actually giving better coupons versus the 10-year. So you could see that the spread is actually at a 10-year high. Likewise, huge capital inflow into equities. We could see also seeing huge capital bond investment inflows, year on year since 2015 into onshore Chinese bonds as well. So that in general has actually been the driving force for the performance of the Chinese market at the moment. Yeah, I see. Thanks, Adrian, for
sharing with us your views on the Chinese markets. Indeed, I've been covering the Chinese markets for the last 9 months, or based on my tracking of the Hong Kong and the Chinese markets over the last 9 months. Indeed, during this period, even with the COVID kicking in, the consumer sectors, whether it's consumer staples or discretionary, has been relatively strong and resilient, even without the COVID. So of course, IT is still quite strong as of now, but of course, it will go through some sort of rotation here and there. Uh, of course, if we are concerned with every single issues that we have on hand or all the narrative that we hear from the media, it's going to stop us from ever investing our money or deploying our money in the market. So one of the key concerns would definitely be, or one of the key narrative right now is the US. They are currently relentlessly sanctioning and scrutinizing the Chinese tech and communication firms. And what kind of impact do you think this would have on the Chinese stock market in general?
Well, that's a very good question, Jake.
Yeah.
You know, with the with the U.S. administration right now, you know, providing a lot of imposing a lot of sanction on the Chinese tech company, but you know, we believe that it has actually very little or even no effect. It has no bite to this Chinese tech company. So why do we think so? Because a majority of the business or the target audience of these Chinese companies are actually within China, within Asia. So for example, you know, the recent case of TikTok, right? Their algorithms and their AIs are situated and parked within China. So even if anything were to happen in TikTok, if there's anything that the U.S. administration wants to do, put any sanction on TikTok, it will not have major effect because you know the majority of the clients and the target audience are still within Asia, right? It doesn't affect their business model at all. Also recently there is a ban for WeChat app in US. You know, so WeChat is actually a super app, you know, where users use this app for news, for e-payment, and for communication and for communication, right? But actually, most of the adopters of WeChat, most of the users of WeChat is actually is in Asia. So you know, with these sanctions and things like that, the business model is generally left untouched from what US is trying to do. So from this saga, we believe that you know this Chinese tech company would definitely want to hedge the possibility of the digital iron curtain falling down on them. So most of the ADR probably want to seek dual listing, and you could see that you know, and believe that Hong Kong Stock Exchange will benefit from such things. And also from this saga, right? You know, we know that there are more than over 100 unicorns and startups within China, and you know, with these sanctions and all but imposed by the U.S. Administration, we think that you know, they will prefer to list their stocks on Hong Kong, on Shanghai Exchange. So in general, I think it's US loss and China or Asia gain in this action. Yeah.
I see. In fact, I tend to agree with you because, yeah, indeed, the US is trying to drive out the Chinese firms onshore. That potentially could actually benefit us because when these firms comes back for listing, we have more direct and easy access to investing or trading those firms in Asian bourses. And of course, naturally, they being Asian companies, we would have more intimate knowledge of their business model, and we are in fact mostly using their applications. So it's good that they actually, or rather it's good that the US are driving them back. I feel that this is a good opportunity for us to actually grow over the next 5 to 10 years. Yep. So that that also means that the ChiNext, it's sorry. So that it's also in conjunction with the fact that the Chinese regulators are currently, or they have just scraped the Qfii and the RQFii investment quota limitations last September. This, of course, this is part of the efforts to relax the capital controls and the other efforts such as loosening the rules on foreign ownership. The ChiNext also recently announced reforms such as widening of the daily trading band from 10 to 20% and stiffening the delisting process and tightening the disclosure requirements and streamlining the approvals of new offerings. How do you see these reforms benefiting the Chinese markets and in particular the ChiNext?
Again, that's a very good question, Jake. So they yep. So with sorry, Jake. Okay. Yep. Sorry about it. So with the tightening of the requirements by the regulators, right? That is actually it's actually to address to reflect more transparency from these companies to the investors. So and also they are also adopting in a very shorter time kind of IPO process. They have also request or they impose a stronger a higher increase in the quality of the listing sponsor. So speed to market to get the company up, increase the transparency of the disclosure requirement that will actually increase the confidence of the investors into ChiNext, and also demand from the higher quality of listing sponsorship. So in general, it's actually a good start by the Chinese government to show up, to tighten, and to also to be transparent of the China market. So I think that is actually a very good start for onshore Chinese market in general.
Yeah, indeed. I've been investing in China myself, and I've witnessed how the Chinese regulators, or rather the Chinese governments, have been taking steps to open up their markets, and all this move, I would say, is in the right direction, except that it's a bit agonizing because we've been waiting for the last 10 years. They are taking baby steps to move towards that direction. I think it's definitely good. In fact, my investments over the last 17 years have more than doubled, if not nearly tripled, for doing nothing. Those are passive investments. I try not to trade them. I mean, I do have trading portfolio, but that's not meant for trading. So yeah, I would say the Chinese story started more than 2 decades back, and it's still growing. And definitely, if we look at ChiNext itself, is one of the higher growth segment within the Chinese markets. So Ethan, would you like to share with us what are the growth rates we're looking at?
So in general, ChiNext is actually comprises of companies that's actually very young and very short tenure, very short lifespan. In terms of the price to PE, or we call it the PE ratios, right, would definitely be very, very high. However, if you look at the studies, right, and by looking at high growth in companies, by looking at the PE ratios, they may not paint a full picture. So what we do is actually we probably could look at the PEG, the PE growth rate, right, and we could see if you compare it to the major indices like the Shanghai 50, CSI 300. In August, ChiNext is still is still having a positive PE growth in August. So if you compare that with the big cap stock in terms of valuations, in terms of valuation and the growth rate, right, of such big company, we believe that ChiNext is actually it's a much cheaper and value stock. Yeah.
Well, Adrian, I'm a numbers person, so I believe in statistics, and I've been doing this myself. So yeah, the numbers don't lie. Of course, indeed, we're talking about the broad market in general, so we are not talking about specific companies or names, right? So, but of course, that being said, the ChiNext has been quite alien to a lot of investors out there. Unlike the main boards that we are used to, like the CSI 300 or the CSI 100, the housing index, a lot of people are not familiar with the names in ChiNext. So would you like to just mention one or two names within top two names within the ChiNext that you would like to highlight to our audience?
Yep. So one of the we do have a few like top names within ChiNext, and you rightly pointed out. So Jake, China is very far away from here, and some of the investors do know that believe that China is actually doing well, leading the recovery growth and everything. But when you ask non-Chinese investors to invest into some of the companies within China, probably everyone is probably pretty clueless of what to invest in such a huge universe, right? But just to share, one or two names within ChiNext. So one is actually Mirei, Shenzhen Mirei Biomedical, right? The CEO is actually Li Xinting. So he stays in Singapore, and according to Forbes, he's actually the second richest man in Singapore. What does this company do? This company is actually a ventilator supplier. So, with the COVID-19, most of some of the patients that suffer from COVID-19 requires assistance in terms of getting this ventilator to provide oxygen to them, to make sure they survive. So, hence, there was a huge demand by hospitals during the pandemic, and that result, share price is rallying, from the March lows to now by 50%. Yeah.
This search, I guess, is quite event-driven, but of course, we have to not just look at event-driven scenarios. We have to look at the fundamentals of the company and the growth story of the individual companies as well. I believe this is one of the top three names within the ChiNext index. Do you have any more names that you want to share with us?
Yeah, sure.
So we did prepare another slide.
It's called Is My
Information. Yeah. So it is a web that we use. It's actually a company that operates an online financial information platform. So it's like a Bloomberg of the East. They provide financial information, and they also provide internet advertising and financial data to investors in China. So this is actually one of the top constituents within ChiNext as well.
Great, thanks, Adrian. So since the components are mainly high growth names and naturally comes with higher valuations, the statistics also suggest that the volatility and the beta is much higher than usual blue chip names in the main board. So how can one confidently invest in the ChiNext, and what are the benefits of using an ETF such as the CSOP Shenzhen ChiNext ETF to engineer such an exposure?
So like did mention before, discussing this section is that, most of the investors, has a story, has a big picture to invest. They want to invest in China. They even have a bigger picture of like, which industry or which sector to invest into. But, most of the times when they talk about names of particular companies, it requires some time to do fundamental research on the company. And, that might take a lot of time. So, we have met, even like, huge Korean or Japanese institutions who wants to invest into China, but they do not have the time. They want to speed to the market, and they don't know what is. They have an idea, but they don't know what company to invest. So with an ETF, they provide an easy access to action, to provide actionable to what their investment objective. And second is actually they use ETF for diversification, right? ETF consists of a basket of stocks, track the performance of the underlying index. So again, they with the benefit of diversification, institutions and investors are actually do away with the risk of a single stock exposure. So the two benefits is actually diversification and using ETF for easy access into markets or things that you do not familiar with.
Okay, great. Thanks for sharing with us on your market views and especially how an investor can invest in the high growth segment of the Chinese markets, and also the benefits of getting the exposure and gaining the benefits of using an ETF to engineer an exposure through the ETF products available. And of course, not forgetting the benefits of using an ETF is definitely diversification and time to market. It's very fast for anyone to move in and out of the whole sector or the industry using just an ETF. And of course, Adrian, would you like to tell us what the ETF is about?
Most certainly, yes. So we have an ETF that tracks the ChiNext index. So it's about embracing the China new economy. Just to share a bit more about ChiNext index, it's actually it comprises of 100 largest and most liquid A-share stock market listed on the Shenzhen Stock Exchange. Now, if you look at the index itself, it has actually outperformed major indices globally. So from year to date, the Chinese index is actually garner over 51% return. If you compare it to the Hang Seng index, it's actually still down about 10%. And then if you look at the S&P 500, it would be S&P 500 only returned back about 8%. Even in if you compare it to the outperformer Nasdaq, right? We still outperform Nasdaq as well. So ChiNext is actually it's a clear winner in 2020 till now among the major stock market, and with 51% return. And like Jake did mention, ChiNext, we always regard ChiNext as actually the Chinese Nasdaq in China, right? And a large portion of it is actually into new industry and high tech growth, and also companies with high outstanding growth potential. So these are some of the key points. And if you will compare the underlying companies and how old are these establishments, right? 68% of the companies within ChiNext are fairly young, about 10 years old, versus some of the major companies. So ChiNext is actually allows investors to invest into exposure into high growth companies. You should consider ChiNext. If you want high growth companies, you should look at this ETF as well. Just to stress one more point is that This ETF is the one and only that tracks the ChiNext index globally. Yeah, that's right, Adrian. Apparently,
I did a search on Bloomberg, and this is the one and only ETF listed in Hong Kong that tracks the ChiNext. Yeah. And yeah, just to continue, yeah, I'm sure the ongoing U.S.-China trade war and tension is naturally not news to us at all. And of course, the recent turn in events have actually spurred the partial return of U.S.-listed Chinese companies back to Asia, and the Hong Kong equity market seems to be really embracing them. In particular, names like Alibaba, JD.com, NetEase, Yum China, and more recently, a firm backed by Alibaba called ZTO Express. We just started trading on this Tuesday, and it raised about 1.5 billion US dollars. Even names like Autohome is also planning for a $1 billion listing, and Ctrip and Baidu may soon follow suit. So in July, we see Hang Seng launching the Hang Seng Tech Index to meet growing investor demand for growth stocks in the main board. So it's definitely a much needed move to complement the financial and property heavy Hang Seng Stock Index. And also this move will serve to better reflect the growth in the tech sector on the names in the main board. So following the launch of this index, I would say CSOP was the first to launch an ETF tracking this index. So Adrian, can you please tell us some key features of these CSOP Hang Seng Tech ETF, stock code 3033?
so most certainly, yeah. If we would talk about ChiNext as the China Nasdaq of the East, 3033 or the Hang Seng Tech Index, we would always we refer it as the Oriental Nasdaq Index, 东方之珠, right? So like Jay, you did mention, with the possibility of more sanction coming upon being imposed on the Chinese tech company listed as ADR on Nasdaq and in US, right? And with that happening, I think Hang Seng realized that it's a crisis for them, and they never waste the crisis. They went to launch this third flagship Hang Seng Tech Index, and rightly mentioned, we managed to secure the rights to launch the first ETF that tracks this Hang Seng Tech Index. So it's called CSOP Hang Seng Tech Index ETF with the ticker 3033.HK. And the reason why we want to be the first adopter for this ETF and that tracks this index, because we did the back testing, and what we did with the 5-year back testing is that technology companies always create exponential kind of returns, and hence we could say that it creates fortune, right? Just like Amazon, it created a huge fortune for the founder. Things like that. Yeah. So we did a 5-year testing. So by comparing Hang Seng Tech Index with the Hang Seng Index itself, you could see that Hang Seng Tech Index is actually outperformed by about 140%, versus the Hang Seng Index is only about like 4% return. The reason why is because the Hang Seng Tech Index is actually very focused on to technology, while the Hang Seng Index is actually more focused on the old economy and more established companies. We did a study like on average, the establishments or the companies within Hang Seng Index is about 60 years old, comparing to the companies within the Hang Seng Tech Index is about 5 to 10 years old. So just to see like the major drag for the Hang Seng Index is actually HSBC. After the global financial crisis with the persistent low interest rates and stuff like that, financial sectors actually causing a drag to the Hang Seng Index.
Great.
Thanks, Adrian. In fact, talking about back testing, I do a lot of back testing. In fact, I think I at least ran more than thousands of back tests, and indeed, I can say whether it's academic evidence or actual practical application of sector rotation or sector allocation in terms of your investment returns. Tech has always given anyone the highest returns throughout time. Of course, notwithstanding that it goes through economic cycles, recession, boom and bust. That being said, it's still one of the best performing sector. So it should definitely warrant attention or preference in terms of overweighting tech in your investment portfolio. Of course, the banks, a lot of people love the banks simply because of high dividends and the safety that comes along with it. Yeah. Of course, there are some specific names that we should stay out from because of inherent problem fundamentally to those specific companies or specific banks. And of course, some of the old economy names are somehow at some point will be replaced. Names like, for example, GE is the one and only name that started when Dow Jones started back more than 100 years ago. So index investing, or at least you have a strategy of using or sticking to an index to invest, helps you to eliminate names that could potentially be falling behind economic growth or economic revolution. Yeah. So, and thanks again, Adrian, for sharing with us and answering so many of our questions. And of course, we can go on for hours and hours and oops. Oops. Yeah, so sorry, missed out something. Yeah, we can go on for hours, and I think right now is the time to do a Q&A.
Gladly. Maybe before we could the Q&A, maybe I just want to share one special feature of the Hang Seng Tech Index. So they have the fast entry, IPO fast entry rule for this index and for this ETF. So this is actually one very quick beauty about this index and this ETF is that let me give you an example. Ant Financial is looking to list in Shanghai and in Hong Kong as well. Mm-hmm. And if Ant Financial were to end on the first trading day and end as a top 10 in terms of market cap, in terms of the technology companies on Hong Kong Stock Exchange, Ant Financial will be selected to be added into the index and into the ETF as well. So when would the effect kick in? The effect will kick in after the 10th trading day. Mm-hmm. On the 11th day, Ant Financial will be added into the index and naturally be added into the ETF as well. So what I'm trying to say is that this ETF has this beauty function of IPO fast entry rule. This provides, when the investors invest into this ETF, and if there's any, new IPOs that's actually in demand, in hot demand, and it's actually a reflection of what the business macro picture, right? It will be added into the ETF, and the ETF managers, which is CSOP, will actually do automatically rebalance the underlying constituents and add in, the newcomer and remove the laggards within the index itself.
So it's the flexibility of fast tracking names that you want to include in the index.
That's right. That's right. Yep.
Okay. So Q&A.
Yes.
Yeah. So
Okay, we have, okay, just let me go through some questions. Okay, we have a question asking, is it true that some stocks in ChiNext are not available for retail investors? Can you confirm whether CIMB can access CATL? Okay, I'm not sure what the code is, but Adrian, would you like to answer this question? The first part of the question, rather.
Oh, okay.
Yeah.
For retail investors in Singapore, I believe there's the EIP, SIP regime, and you have to qualify for that. The stock code the CATL that provides battery to Tesla, and that is actually one of the components for ChiNext. So if you buy the ETF, you naturally be exposed and investing into this company.
okay, based on what I understand,
Is most of the retail investors or clients are restricted from accessing ChiNext directly through your normal trading account. I believe there are some exceptions which the management can actually waive off your access to a particular market, but of course that needs to satisfy certain regulatory requirements. Okay, let's move on to another question. Okay, another question asks, how do you see the current technology trend? Could it turn out potentially into another dot-com bubble, as investors are kind of like in fear of missing out in the technology sector right now, as price has trended up quite a lot, especially in the US. So, whereas in China, stocks like SMIC are still in huge discount due to US sanctions. Okay. I believe. Okay.
can I answer that?
Oh yeah, yes, Jake, if you yeah.
Okay. If we understand financial history, we are constantly creating bubbles. Like it or not, all bubbles will burst. The only question is we don't know when. And if, of course, you are a savvy investor or you're an investor who can time the market, I would say, yeah, why not? But at the end of the day, we have to understand that we are either investing or deploying our investment capital to good quality names. And if we do not do our due diligence, our homework, then there's no point in investing in a particular sector or a company at all. So the bubbles will burst. Of course, when the bubble bursts, it goes through usually correction, not bankruptcy. Of course, during the correction or during the recession, some names will not survive. Names who will not survive are usually fundamentally weaker names. So it's through a correction or recession that you see which are the ones that can survive, and those are the time where you can buy things at a discount. I always tell my friends and my clients, when the bubble bursts, when it goes through a correction, or some people call it crash, okay, it all depends on how you want to phrase that correction, okay. Whether you want to call it crash or market recession, it is actually a good opportunity for longer-term investors to take advantage of good quality assets selling at a discount. notwithstanding the fact that usually the market tend to spend 5 to 6 years moving up in general. That the more actual definition would be 2 years up, 1 year down, 2 years up, 1 year down. You can actually find market rhythm if you study enough market movement or market characteristics. But that's just the market, not a particular company or sector. So these are the market behavior, and of course we can take advantage of it. The problem is it tends to happen over a long period of time. So if you are a money manager, it's very hard for you to time the market that perfectly because you need to constantly invest and deploy your money. For the individual investor, it's also very heart-wrenching to wait for a good 5 to 6 years before you go through a market correction. And that's when you deploy money, or that's when you invest in hugely discounted stocks during a correction. That itself is also very contradictory because when it's time for you to do it, you tend to act out of fear and will not do it. So you tend to miss out those opportunities over and over again. I've seen a lot of my friends who do not dare to invest when the market goes up and will also not dare to touch when the market goes through a correction. So at the end of the day, 10, 20 years down the road, they end up not investing at all. So that's not going to help anyone to build their investment portfolio. I would say corrections are part and parcel of how the market moves. And if you're not prepared to take advantage of market correction or market crash, if you want to call that, I would say it's a big waste because these are opportunities actually. Of course, traders on the flip side will have to be on the right side of the market. So therefore, you have to identify whether you're trading or investing. I hope that answers the question. Adrian, is there anything you want to add?
Yeah, I just want to add on to what you have said. Like, it's very simple from your introduction, right? Every era there is a investment team for that age. It was actually oil. Then before the global financial crisis, it was financial, and now coupled with the macroeconomic geopolitical issue, and with the pandemic, that skew the money managers that you mentioned into the technology. And where do we see trend? I think with so much supporting factor like the change of habits, we can't meet face to face anymore. Adoption of technology would be here. For how long? Like I said, we're not sure, but it should create a long trend, right?
Right, because if you notice through all the
Industrial revolution is actually driven by changes in technology. Of course, how one uses technology to survive or to grow beyond the current market share is, I would say, is up to individual companies' management. But behind those changes are actually changes or improvement in technology. So therefore, technology itself is definitely something that everyone would have to look at. Of course, it will go through its good times and bad times. If you're a long-term investor willing to ride through all the boom and bust, like for myself, I've been investing for the last 18 years. I went through all the boom and bust. I'm still invested. The portfolio easily doubled, if not triple. Yeah. Okay, so I hope to answer that question from Oscar. And of course, let's try to move on to some other questions like.
Jake, I see a question saying that there are some hiccups during the list day for our ETF.
We want to understand.
Yeah. So just to explain, how it happened was that the retail investors were rushing to buy ETF, thinking that it was like a normal hot stock IPO. So they rush in, and during this period of time called market auction just before the market open. Some of the retail investors went to put buy at market. So naturally, back then, some of the when you say buy at market, it means that you want to get filled at whatever cost, whatever price there is. And having said that, system will actually was able to match it at $20. So that was actually back then. I think during the launch, the market makers for ETFs were not participating in that auctioning time.
I see.
Yeah.
So it's more of a market, not not big in the market.
Yeah. So the market makers weren't in the market during the pre-opening and the auction time, and some of the retail investors were using the wrong order type in getting into it, and then they were just placing a market buy market order at buy. Yes, so it got matched at an unfavorable price. So having said that, we should, it's just advice to all investors, be it institutional or retail investors. Every ETF issuer, we do have a website that indicates the net asset value of the ETF. The net asset value derives from all the calculation of the underlying constituents, the price times the weightage of the underlying constituents to derive this fair value, this fair net asset value. So investors should just refer to our website to see the NAV of the ETF, and before looking to buy into the exchange, because the exchange just is the price transacted, right? But if you look at whether you're actually getting a fair value, a fair NAV, by referring to our website.
Okay, great. So actually, to sum up the response to this question, use the right order type, and of course keep track of the reference price, which is the NAV, before you try to punch in a limit order. Yeah. Okay, let's try another question. Okay, I see a question asking what's the forecast on retail sales growth, considering revenge spending, supportive policy, retailer promotions, offset by rising unemployment / reduced income.
Yep. So in the earlier slides, at the beginning of the slides, we looking at a negative of I believe if I can remember correctly, it was in negative in terms of retail sales for 2020, right? But we believe in 2021 when the new year comes, we're looking at about 15 or 16% year-on-year growth for retail sales, and that probably would have been a consensus by analysts and the around the world. So I think that will probably be already looking at factoring the rising unemployment and the reduced income already. Yep.
Okay.
Let's see which question should.
Okay, how about
this?
we have this question asking, considering the
US-China trade war escalated back in 2018, could we see a potential probability that Vietnam will replace China? As we can see, they are one of the major beneficiaries out there. And to add on, he mentioned that statistics also show that back in 2010, the leading producer shoes, Nike, has overtaken China in terms of productions, and also see big corporate investments such as Samsung, Intel, Microsoft shifting their manufacturing plant to Vietnam. Could this be a warning sign to China itself in terms of losing steam, as China is no longer declared as cheap labor in comparison to Vietnam? Yeah. Adrian, would you?
Gladly. China has made it very clear that they want to shake off the tag of being the factory of the world, and by shaking that tag away, they want to position themselves as to increase their GDP via internal consumption. And rightly say so, Vietnam has actually benefited from China's stance, and most of the manufacturing is actually gone to Vietnam, Bangladesh, India, around the region, right? So what China is trying to position themselves is actually they have you know set up many funds and many accounts, and their 5 year or their plans ahead was actually to to create new infrastructure, to create a new infrastructure within China. I think that is also being driven by what's happening with Huawei and what US is doing. They realize they need to be independent and start to build their own infrastructure, their own infrastructure for the country. So in that case, it's not a warning sign to China. China himself wants to shake off make a decision to shake off the manufacturer of the world title, right? And that is not a warning sign. Yep.
Okay.
Shall we do one more question? Yep. One. Okay, one of the question asks, does China bright growth prospects augurs well with the China-based bank stocks, example ICBC? Can I take this question?
Sure.
Yeah. Okay, I've been keeping track of the financial sectors or the banking sector within China and Hong Kong. Yeah, indeed, Chinese growth is definitely here to stay. It's a matter of how fast, and of course, whether we are talking about tech-driven growth or non-tech-driven growth. In this case, the banking sector is a bit problematic in this case because most of the banks in China would have to do national service. If the central bank says, loosen up, lend more money out, even at the expense of reducing your profitability, you have to do it. You don't have a choice. It's a lot of national service baggage that they are carrying right now. So despite having cheap valuations and high dividend yield, in terms of how the banks can turn the profitability around, it's really a big question mark. If you ask me, I would rather stay out or underweight the banking sector within China. But you can allocate some percentage of portfolio to the banking sector to take advantage of the high dividend yield. But you have to understand that there's limited upside in terms of stock prices. So we have to give and take. Because most of the tech names do not carry high dividend yield. So it's a good balancing act to play such what we call the factors within your portfolio. That means you have to balance growth and dividend yield within your portfolio to gain that balance, so that over time your investment portfolio would grow at a compounding rate, and yet having cash as well. Because technology firms typically just give you capital gains without dividend, so that's not the cash component. Yeah, so I hope I answered this question. So with this, I think we should call it one more question. Okay, great. Okay, can I answer? Adrian, would you want to answer this question? For Alibaba, JD, and China tech investors, what will happen to the shares if these counters are forced to delist in Nasdaq?
Well, first of all, I think when it comes to that stage, I think Alibaba, JD, and the Chinese companies would have look for a dual listing in other exchange, and preferably they will probably come back to Hong Kong and Hong Kong exchange to list their stocks. There are many ways how this will pan out. They would probably convert their US shares, and you get a one-to-one exchange or some kind of like ratio change into the new listing in Hong Kong exchange or Shenzhen exchange, for example. If they were being forced to delist from Nasdaq without even getting a listing in Shenzhen or other exchanges, investors they will have like a closing price, and then they will liquidate all the shares, and the investors would actually get back cash based on the last traded price on Nasdaq. So the worst case scenario, forced to delist, it means that the shares will be cash out, liquidated into cash, and then revert back to the investors.
Yeah, based on my observation,
a lot of institutions are already converting or shifting part of their investment allocation to the listing in Hong Kong. For example, Alibaba, JD, and there's another name I can't remember right now. Yeah, but they have already started the process of trying to not rely solely on the US listing. And in fact, for investors who hold the ADR, they can actually easily convert their ADRs to the respective shareholding in a different market. Yeah, so I don't think that's a major problem. But of course, for ADR, for companies with ADRs who doesn't have a second listing, yeah, they will get back their cash equivalent to whatever the net asset value is in terms of the shares that they are holding. And yeah, with this, I think we should end for tonight. And of course, tonight we're happy to announce that we are having a promotion for clients who trade the 4 selected ETFs, stock code 3147, 3033, 3072, and 3091. These are the 4 selected ETFs, 2 from CSOP and 2 from Nickel. If clients were to trade these ETFs over the next 3 months, right? Am I 3 months? You're entitled to a $10 NTUC voucher per trade, and of course, this is up to $5,000 in NTUC vouchers available for grabs. And of course, if you happen to be thinking of investing in the Hong Kong market using all these ETFs, why not take advantage of this promotion and yeah, don't let it go to waste. And I hope tonight's webinar helped to answer some of your questions on the ETFs, especially the CSOP ETFs listed in Hong Kong, and how you can use it to incorporate into your portfolios. Of course, please remember to scan the QR code to register and catch us the same time next week for part 3 of our Dominance of the Virtual World webinar series, the rising of the internet and electronic gaming industry. And for inquiries on investment products and strategy, you can call me at 6210-8698 or drop me an email listed above. For inquiries on CSOP ETF products, you may contact Adrian at 6279-2801. And of course, for
general account opening
and inquiries, you can contact Colin Ng at 6210-8686. Before we sign off for tonight's event, please kindly take a few minutes to fill out our survey form. And thank you everyone for being such a wonderful audience. And thanks Adrian for coming on to the program. And last but not least, thank you Colin for helping us to organize tonight's event. We wish everyone a safe year ahead, and we hope to see you again next week. Thank you very much. Good night.